Hey everybody, Courtney Smith here. Yeah, what can I say? Everything's going great. Hardly any negative things in the marketplace right now. So our job right now is to just lay back, hold our positions for our fully paid up members. I got a ton of more and new recommendations of some incredibly explosive stocks. This is explosive. I mean, we're talking about the climax of a novel here. So let's take a look here. First of all, S&P, we chopped around a little bit over the recent past, but the last 2 out of 3 days were pretty strong, closed on the high of the day on Friday. So it looks to me like we're going to break out of this kind of sideways pattern. Purple Predictor remains bullish. So all in all, bullish. Now, this is not bullish. This is the Dow, but you can see in the upper right-hand corner, it's not very bullish. You can see the red line is above the green line, which means there's more selling pressure than buying pressure. Now, this is really focused on the Dow. So we're really starting to see a bifurcated market here with the big Dow stocks getting pressured, but some of the smaller cap stocks are smoking. And of course, fully paid up members, we don't really own big cap stocks because they're boring. And I'm really not interested in buying boring stocks. I'm interested in buying explosive stocks. So this message is stay away from the big caps right now. They're boring. Now, the Nasdaq, you can see, has been exploding to new highs on the move. This is what I'm saying. Negative pressure in the Dow, but positive pressure in the Nasdaq, and the S&P is in between. So this is where the action is. This is where we need to be. Seasonality is bullish. It's broken. And remember, we're using the Russell 2000. So these are little dinky stocks. And notice we're at new all-time highs this week. So once again, this bifurcation between big cap and small cap is crushing it here. We need to be staying focused there. Now, normally I would put our switch to neutral at the red line, but I think I'm going to be a little bit aggressive and move the switcheroo up to the purple line. So right now we're on a bull mode on seasonality, which means we've got double-sized positions, which of course means we're crushing the market right now. But if it goes below that purple line, I'll switch back to a normal position. All right, and the interesting thing to me is here we are at the beginning of June. We're supposed to be in a bearish seasonality, not a very bearish seasonality, but a bearish seasonality nonetheless, and yet the prices are going up. Now, what that means is that once the negative seasonality is released in September, October, this market's going to take off to the moon. It's going to take off to the moon. And right now, I can tell you what's going to cause it to take off to the moon. Number one, uncertainty about the midterm elections will dissipate. The market will know in September, October who's going to win. Number two, the economy's actually going to slow. So there's a lot of good news about the economy right now. But we're actually going to see the economy slow, and that means that interest rates will probably come down, and it'll be the release of the pressure that higher interest rates are causing right now. The release of that pressure is going to cause the stock market to rally. So keep an eye here. Lots of reasons to believe it's going to rally later. Yield curve. This is also very interesting. So the yellow thing shows that basically the yield curve is going to be a neutral because it predicts the market a year in advance. So it's saying no big deal, not a big explosive bull market, just relax. But look at that red arrow. We cracked down to a new low, a new 2-year low, year and a half low. And the yield curve being that flat is actually not good for the stock market. Now, it's not to the point where it flashes a bearish signal, but it's just going to keep more pressure on the market. Not downward pressure, but capping pressure. It's not going to allow the market to rally as much as it wants to. So now if it got down to like 0.25, then I'd be freaking out. I'd be selling everything. I'd be buying ammunition and canned goods, okay? So we need to keep a close eye on this because it has broken down to a new low. Asset allocation, not a whole lot of anything this week. But the risk indicator moves to new highs. The market participants are screaming for more risk. They want, and of course we know that because we saw the IWM really strong, we saw the Nasdaq really strong, and the safe havens like the Dow stocks, they're saying, we don't want that kind of garbage. We want these frisky, wild and crazy small cap stocks. We don't want those stodgy blue chips. They're boring. Oh, by the way, I'll tell you why they're boring in a minute. Global shares cracked down mainly on the Italian situation where there was the possibility, not a probability yet, but a possibility of an Ital exit, where Italy would come out of the European common currency. And so that's really hurt a lot of European stocks. Obviously, Italy was in particular hit very hard. Bonds. We got the big rally that I told you about, and now we've sold off a bit. I'm looking for this week to really just go sideways. Take a look at this. Our factors. Now, the green is the interest rates. But look at our three key indicators. The gold line is gold. It's cracking down, suggesting lower interest rates. The most important indicator is the blue line, which is 10-year Treasury yields in Germany. It's really in a clear bear market. So that's really going to put pressure on the dollar. The only thing that's, on the 10-year interest rates. So the only thing that's really pointing to higher interest rates is the CRB, which is the chart down below, and it leads the 10-year Treasury. So it's not telling us we should be worried right now, but down the road we should be worried. Now, if we see the green line and the blue line so divergence, if we see U.S. interest rates very, very high and German low, then you would anticipate that the dollar would be very strong, and it is. Look for that to continue, although I think we're starting to run out of gas. So this bull market in the dollar may only last 2-3 weeks, maybe 4, but it's starting to run out of gas. So we need to start watching for reasons to get out of positions, not reasons to get into positions. Now, if the dollar's strong, then gold's usually weak. So we talked a lot about this last week, but we basically got up to the throwback. We threw back to the breakout level at around 1305, and we've just been chopping there. I think this is going to crack down. I think it's going to crack down. Our indicators, the top indicator, somewhat bearish. The middle one, which had been bullish, is now bearish. The bottom one, I'll let you call it. We did have a sharp rally over the previous 2 weeks, but then we kind of hooked down this week. So all in all, let's call it somewhat negative, our three key indicators here. Now, I told you last week I'm now super bearish on oil. Now, not as bearish as I was last week, but we saw Saudi Arabia and Russia agree to increase production dramatically. That's what caused the breakdown. They kind of reneged on that a little bit this week, so it's not quite as bearish. But it doesn't matter because the Americans are going to be pumping 1.4 million barrels a day by the end of the year, more than they are now. So it's going down anyway. So look for a move down into the $50 range as the first downside objective. Bitcoin has performed exactly as we told you it would. We got down to about 7,000, and I think that's about where we're going to go. Look at the purple predictor. The purple predictor is hooked back up, showing that smart money is using this dip in Bitcoin to accumulate positions. So look for Bitcoin to now rally back up closer to the 10,000 level. Let's say you can see the top blue line at 99.66. That would be my objective. Up towards that area would be my objective on Bitcoin. So right now buying at 7,600, looking for, let's say, up to 9,600. That's $2,000 per Bitcoin. Makes a lot of sense to me. And you can put stop loss below the lows we made 4 or 5 days ago. So this should be a pretty good trade for us. All right, that's it. Oh, those are old. Who cares? All right, everybody. Thanks very much. Love having all you freebies. But fully paid up members, you are, of course, my closest and dearest friends. Just hang on for just a second.